What is price action trading? Price action trading is a methodology that relies on historical prices, open, high, low, and close, to help you make better trading decisions. Unlike indicators, fundamentals, or algorithms, price action tells you what the market is doing, and not what you think it should do. First, let's define what's support and resistance so we're all on the same page. Support, a horizontal area on your chart where you can expect buyers to push the price higher. Resistance, a horizontal area on your chart where you can expect sellers to push the price lower. But why does it happen? Because when the price breaks support, traders who are long are losing money and in the red. So, when the price rallies back to support, this group of traders can now get out of their losing trade at break-even, and that induces selling pressure. And that's not all, because traders who missed the breakout will want to short the markets, which increases the selling pressure. And that's why when support breaks, it tends to become resistance. Make sense? Now you're probably wondering. The 20-period moving average can act as dynamic support in storm trending market. The 50-period moving average can act as dynamic resistance in a healthy trend. The markets are always changing. I'm sure you'd realize this by now. It can be in an uptrend, downtrend, range, low volatility, high volatility, etc. But, if you take a step back and look at the big picture, you'd realize the market tends to be in one of four stages. The accumulation stage occurs after a decline in price, and it looks like a range market in a downtrend. Here are the things to look for. Occurs after the price have fallen over the last 5 months or more on daily. It looks like a range market with obvious support and resistance areas. In a downtrend, the 200-day moving average is flattening out. The price whips back and forth around the 200-day moving average. The advancing stage is an uptrend with a series of higher highs and lows. Here are the things to look for. Occurs after the price breaks out of resistance in an accumulation stage. You see a series of higher highs and lows. The price is above the 200-day moving average. The 200-day moving average is starting to point higher. The distribution stage occurs after a rise in price, and it looks like a range market in an uptrend. Here are the things to look for. Occurs after the price have risen over the last 5 months or more on daily time frame. It looks like a range market with obvious support and resistance areas. In an uptrend, the 200-day moving average is flattening out. The price whips back and forth around the 200-day moving average. The declining stage is a downtrend with a series of lower highs and lows. Here are the things to look for. Occurs after the price breaks out of support in a distribution stage. You see a series of lower highs and lows. The price is below the 200-day moving average. The 200-day moving average is starting to point lower. What's the point of learning the 4 stages of the market? Here's the thing. If you can recognize the current stage of the market, then you can adopt the appropriate trading strategy to trade it. Here's how. If the market is in an advancing stage, then you want to be a buyer, not a seller. This means you can look to buy breakouts or pullbacks. If the market is in a distribution stage, then you know there's a huge potential downside if the price breaks below support. This means you can look to short the breakdown of support or wait for the breakdown to occur, then sell on the pullback.